These are the investments that paid me $281 for the month of November. I'll be breaking down how much I get from each stock and the amount I've actually invested in it, and the future plan for my holdings, just in case if you're interested in following along and also interested in making $281 for the month of November. Well, hopefully way more than that. Also, let me know what you've invested in that pays you dividends. I'm interested to know your investment thesis and if I can incorporate some of that and see some good gains. The first stock is an investment in the S&P 500, particularly through a covered call ETF called HYLD. The stock paid me $88.52 for the month of November, nearly $90, and has become a cornerstone for my portfolio when it comes to the income I get from it. Covered calls are controversial in investment circles online. They sacrifice long-term potential growth, or at least some long-term potential growth, for income. Now, as you'll notice with this ETF in particular, HYLD, it has been up more than 15% over the last year, but the S&P 500 has been up way more than that. The catch is that this actually pays a decent dividend yield at 12%, compared with the 1-point-something% of the S&P 500. That basically means that it pays 10 times what the S&P 500 pays. These $90 I'm not extracting, I'm just putting back into my portfolio, and I like to watch this number go up because it's a huge motivating factor for me to continue investing. I do not get anything from selling stocks since I am a buy and hold investor for the long run, so I use this monthly income as a way for keeping myself motivated. I have roughly $8,700 invested in HYLD, with plans of taking this number up to $10,000 in the near future. The next stock that paid me dividends was Apple. Apple is a technology company that we all know about. They make products like the iPhone, iPad, and MacBook Pro, technology products, hardware mostly, that a lot of people use and, in fact, love to use. They dominate the smartphone market, particularly in North America, and have other revenue streams through the App Store, as well as other hardware products. Their revenue has been steadily increasing over the last few years, profit margins have been expanding, and they also pay a dividend now. Although the dividend yield is minuscule compared to the previous ETF, and they only paid me $10 for this month. But the investment philosophy is different for Apple. It's a long-term hold for a company that's expanding margins and will hopefully go up in stock price as well. Similarly to HYLD, I have nearly $8,900 invested in Apple, with plans of buying a few more shares as I get money. Nothing crazy compared to the overall amount of my portfolio, but enough to make me realize some gains in the stock price appreciation and also get this $10 for the month of November. The next company that paid me dividends was Procter & Gamble, or P&G. P&G makes household products and is a huge player in the consumer packaged goods industry. From diapers to toilet paper to air fresheners to products that you eat and drink, P&G manufactures everything. And similarly to Apple, although revenue has not increased at a huge rate over the last few years, it does steadily go up and profit margins look healthy as well. The big plus is that the dividend yield is actually pretty good at 2.5 to 3% depending on the price of the stock. And this month they paid me $25, well, nearly $26. I have nearly $4,764 invested in P&G, with plans to take this amount to $6,000 before the end of 2025. I know that's way down the line, but it's good to plan for the future, at least 1 year down the line. The next ETF that paid me dividends was VDY. This is an ETF that tracks the Canadian S&P 500, also known as the TSX60. Banks, insurance companies, telecoms, all major Canadian companies are pretty much included in this ETF, and it also has a decent dividend yield at 4.3 to 4.8% depending on the price of the stock. This month alone, it paid me $76 nearly, and it's also been up 20% nearly over the last 2 years. So I'm not only getting the dividend yield, I am also getting stock price appreciation. These steady Canadian industries are always going to be around. Everybody needs a phone, everybody needs a bank, and everybody needs insurance, at least in Canada. So I think it's a good investment for the future, at least for my investment goals. I like having that modest price appreciation, but also having that nice dividend yield that keeps me motivated to keep investing. I have nearly 16% of my portfolio invested in VDY, or around $24,000, with plans to increase this to $30,000 eventually. Speaking of the Canadian market, my next big pair was HDIV, another covered call ETF tracking the TSX60. We've talked about HYLD before. This is basically the same, but tracks the Canadian market with some exposure to US financials. Share price appreciation is there, with this returning around 17% over the last year, and the dividend yield is nice and juicy at around 10%. This paid me nearly $67 for this month, all money that I reinvested to buy more shares of this ETF and others as well. I have nearly $7,000 invested in HDIV, and I plan to increase this to $10,000 eventually, although I don't know how long that's going to take since a majority of my holdings are still in growth-focused ETFs. I will say though, if I do like covered call investing, maybe 10 years down the line, I might change and invest largely in covered calls, who knows? But for now, since I'm young, I think growth ETFs are a much better deal. Speaking of growth ETFs, my next investment was in HEQL. This is an all-equity ETF with some modest leverage. All equity essentially means that it tracks the US market, the Canadian market, but also has some exposure to international markets. Leverage adds an extra element to growth. This ETF is 25% leverage, which basically means that any returns are magnified by 25%, but at the same time, losses are also magnified by 25%. So let's assume that the underlying holdings go up 10% in the next year. This ETF will be up 12.5% minus leverage cost, or the interest fees that the ETF provider has to pay. But if the underlying holdings go down 10%, the ETF is going to be down 12.5% plus leverage costs, so around 13%. The pros and cons are there, but I think for a long-term investor like myself, the choice to add on modest leverage might pay off nice dividends. Speaking of dividends, this also paid me around $4 this month. $4 I can count on one hand, but the snowball is increasing. This used to pay me $1 a few months ago, now it's $4. Who knows, maybe a year or two from now, this would be in the 10s or 20s. I have around $2,600 invested in this, with plans to increase this to $5,000 gradually. My last big pair was American Express. American Express is a credit card company, much like MasterCard and Visa, although they focus mostly on the travel market, particularly luxury and high-end travel. I think with travel returning to normal over the coming years and also getting extremely expensive, Amex is going to see nice dividends. Travel is not an essential expense, but is considered to be one of the most important expenses for people if they can afford it. With Amex's offerings getting better as time goes on, it's reflected in their revenue and their profit margins. With interest rates falling, people will have more disposable income and perhaps will spend more on travel as well. Logically and theoretically, it makes sense. Let's see if that pays off. From a dividend perspective, this has paid me $4 for this month for an initial investment of $1,600. That's it, those were my major pairs for this month, my future plans for those holdings, and some logic and rationale for each of them in case you're interested in following along or need some motivation to keep consistent in your investment journey. Don't forget to smash the like button and the subscribe button. Every subscriber helps get this video to the right people. Also interested in learning more about money and how to save and invest more. I hope you enjoyed this, and I'll see you in the next one.